Each of the following events is required to be reported to the United States Securities and Exchange Commission on Form 8, except. Well, please note, in Form 8, we report all major corporate events which are significant, like any management changes, any changes in accountant, you have hired a new accountant, changes in securities, any acquisition and disposal, that needs to be reported, right? So it says all of the following would be reported in the Form 8K, except unregistered sale of equity securities, an element to be disclosed in 8K. Change in our registrant's certifying accountant needs to be reported in 8K. The creation of an obligation under an off-balance sheet arrangement of our registrant, the company, it is also to be reported in the Form 8K, assuming that it's a significant event. So what is not required to be reported in 8K? The quarterly results of operations and financial condition of a registrant, that is required under Form 10Q. So this is it. That is the right answer. On December 1st of the current year, Clay Company declared and issued a 6% stock dividend on its 100,000 shares of outstanding common stock. There was no other common stock activity during the year. What number of shares should Clay issue or use in determining basic earning per share for the current year? Remember, stock dividend, stock split, they are retrospectively treated. The 6% stock dividend, 6% of $100,000, 6,000, it would be assumed as if it was outstanding for the whole year, which means the number of shares you will use for calculating your basic earning per share is 106,000, and that is A. UTE Company had the following capital structure during year 1 and year 2. Preferred stock $10 par, 4% cumulative, 25,000 shares issued and outstanding, $250,000. Common stock $5 par, 200,000 shares issued and outstanding, $1 million is the amount, 200,000 times 5. UTE reported net income of $500,000 for the year ended December 31st, year 2. UTE paid no preferred dividend during year 1 and paid $16,000 in preferred dividend during year 2. Okay, remember they are cumulative. In its December 31st, year 2 income statement, what amount should UTE report as basic earning per share? This is the formula we use for calculating basic earning per share. Income available to common shareholders divided by the weighted average number of common shares outstanding. Basically, there is no change in number of shares. So in the denominator, we have no problem. It's going to be 200,000 shares. The issue is with income available to common shareholders. So we should start off with the net income, which is given as $500,000, right? That is the net income. And from this net income, we need to deduct the cumulative preferred stock dividend. Now, since the preferred stock dividends are cumulative, so we have to deduct them from our net income, irrespective whether they have been declared or not or paid or not. So just for this year, 10 is par, 4% cumulative, that means 4% of direct this amount, that is $10,000. So this is your income available to common shareholders or common stockholders, and the denominator will have 200,000 shares. So it's going to be 490 divided by 200,000 shares, and your basic earning per share is 2.45, and that's D. Next, West Company had earning per share of $15 for the current year before considering the effects of any convertible securities. No conversion or exercise of convertible securities occurred during the year. However, possible conversion of convertible bonds would have reduced earning per share by 0.75. The effect of possible exercise of common stock options would have increased earnings per share by 0.10. Now this is important. Our convertible bonds, they are dilutive, and their dilutive potential is that they are going to reduce EPS by 0.75. However, possible exercise of common stock options would increase EPS. When exercise of such instruments cause increase in earning per share, they are called anti-dilutive and they are ignored in that case. So what you're going to do, which amount should West report as diluted earning per share for the current year? So your basic earning per share is $15, and the conversion feature of these convertible bonds would reduce your EPS by 0.75. So you're going to report 15 less 0.75. So your diluted earning per share will be 14.25. That makes C to be the correct option. EN Companies calculating earning per share amounts for inclusion in EN's annual report to shareholders. EN has obtained the following information from the Controller's Office as well as Shareholder Services. Net income from January to December 31st, 125,000. Number of outstanding shares Jan to March 31st, 15,000. April to May 31st, 12,500, and June to December 31st, 17,000. In addition, EN has issued 10,000 incentive stock options with an exercise price of $30 to its employees, and year-end market price of share is 25 per share. This is clear indication that your stock options are out of money, because these options give you the right to purchase the stock at $30, which is available in the market at $25. Why the hell would you exercise such an option to buy the stock at $30 by paying $30, which is available in the market for $25? So you will allow the options to lapse. So basically the options are anti-dilutive because the exercise price 30 is more than the market price of the stock. Go to the market and purchase the stock instead, using the or utilizing the option or exercising the option. So ignore this completely. What amount is EN diluted earnings per share for the year ended December 31st? Okay, now these 15,000 shares stayed outstanding for 3 months, Jan, Feb, March. So give them the weight of 3 out of 12. Then the next number of shares, April to 31st May, 12,500, April, May, so they remain outstanding for 2 months out of 12. And then the last, June to December, if you calculate the number of months, June, July, August, September, October, November, December, 7 months. So 7 times 12. So if you calculate these numbers, the first computation gives you the weight of 3750, 2083, and the last one gives you 9917. If you add all these, the weighted average number of shares is 15,750. Right? The actual number of shares outstanding at the balance sheet date is 17,000. But the weighted average we will use for earning per share calculations 15,750. So let us calculate the earning per share, basic earning per share, income available to common shareholders $125,000 divided with 15,750, and it gives you 7.94. Now the question says, what is the diluted earning per share? This is basic earning per share as well as it is the diluted earning per share, because these stock options are out of money. They are anti-dilutive or anti-dilutive. So your basic earning per share is your diluted earning per share. So the answer stays the same, 7.94, and that is A. A company is an accelerated filer that is required to file Form 10K with the United States Securities and Exchange Commission. What is the maximum number of days after the company's fiscal year end that the company has to file Form 10K with the SEC? This is straight from the textbook. Your textbook says that a deadline of 75 days is available for filing of Form 10K for accelerated filers. So look no further. D is the answer. On January 16, Tree Company paid $60,000 in property taxes on its factory for the current calendar year. That is the starting of the year for the whole year. On April 2nd, Tree paid $240,000 for unanticipated major repairs to its factory equipment. The repairs will benefit operations for the remainder of the calendar year. So this amount has been paid for the full year from Jan to December, 12 months. And this amount has been paid from April to December. April, May, June, July, August, September, October, November, and December. 9 months, that is 3 quarters. So the repairs will benefit operations for the remainder of the calendar year. What amount of these expenses should Tree include in its third quarter interim financial statements for the 3 months ended September 30? It's a very straightforward question. So what you're going to do, you are going to take this 60,000. It's for 4 quarters. So the quarterly amount to be reported as an expense is $15,000. Because for interim reporting purposes, costs that benefit multiple periods should be allocated equally to those periods. So this is what you will consider for the third calendar quarter. Then you pay $240,000, and this is for 3 quarters. 90. Remember, we just started counting from April to December. 9 months, 3 quarters. So that means 80,000 per quarter. So the total amount you're going to report as expenses is 80 plus 15, that is 95 is the answer. A US publicly traded company's second fiscal quarter ends on 31st March. If the company is an accelerated filer, what is the latest date that the 10Q should be filed with US SEC? Remember, for large accelerated and accelerated filers, the 10Q report is due within 40 days of the period end. So if your period is ending on 31st of March, that means the whole of April, 30 days, plus 10 more days, that means 10th May. That means 10th May is the deadline. B is the answer. DEC company had 120,000 shares of common stock outstanding at 1st of January year 2. On July 1st year 2, it issued 40,000 additional shares of common stock. Outstanding shares all year were 10,000 shares of non-convertible cumulative preferred stock. What is the number of shares that DEC should use to calculate year 2 earning per share? Of course, earning per share involves only the common stock. So we have 2 stock transactions related to common stock, or 2 pieces of information related to common stock. One is the total outstanding stock, 120, which remained outstanding for the whole of the year. We give it weight 12 out of 12. And then these 40,000 shares, they were issued on 1st of July. So July, August, September, October, November, this exact 6 months. So 40,000 will carry a weight of 6 out of 12. So that makes 20. So 20 plus 120, 140 is the number of shares that you will use to calculate your earning per share. We can solve this question using the different approach we used at the beginning of this lecture. Your shares from 1st of January to the end of June were 120,000. So we give them weight of 6 out of 12 months. Then from 1st of July till the end of the year, you had a total of 120 plus 40, a total of 160,000 shares, which remain outstanding for 6 months out of 12. So if you calculate the weighted average now, it's going to be 60,080. You get the same answer. So no matter which approach you use, be careful, use it correctly, and you will get the correct answer. Po company had 300,000 shares of common stock issued and outstanding at December 31st, year 1. No common stock was issued during year 2. That means this is the weighted average number of shares because there is no stock transaction. On January 1st, year 2, Po issued 200,000 shares of non-convertible preferred stock. During year 2, Po declared and paid $75,000 cash dividend on common stock and $60,000 on the preferred stock. Net income for the year ended December 31st, year 2 was $330,000. What should be Po's years 2 earning per common share? We know what to do. We need to find out how many shares were outstanding. We know that given as it is. And what is the income attributable to or income available to common stockholder? That is the numerator. So we have the denominator. Let us find the numerator. And this one is fairly straightforward. Our net income is 300,000, not 300, sorry, it's 330. It's 330,000, and our preferred stock for the period 60,000. So we got 270 divided by 300,000, and what you get is your answer D. A firm has basic earning per share of $1.29. If the tax rate is 30%, which of the following securities would be dilutive? 6% 100 par cumulative convertible preferred stock issued at par, with each preferred share convertible into 4 shares of common stock. First of all, a dilutive security, any of these will be, we'll see. It will produce an earning per share below basic earning per share. So our current earning per share basic is 1.29. Let's see what these securities do. If you consider A, $100, 6% cumulative convertible preferred stock. That means $6 would be the dividends saved if these cumulative convertible preferred stock are converted to common shares. How many? 4. So 6 upon 4, that 1.5 per share. Since they are anti-dilutive, see, the amount is higher than the current basic earning per share. So you can say that these convertible preferred stock are anti-dilutive. So this is not clearly the answer. Next, B says cumulative 8% $50 par preferred stock, and there is clearly no indication whether they are convertible or not, so we are going to cross this out as well. What about C? 7% convertible bonds issued at par with each 1000 bond convertible into 40 shares of common stock. So if these bonds are ever converted, we will save some interest amount. What that amount be? It's going to be 7% of 1000 on after tax basis. 1 minus 30%, it will be $49. So $49 is the interest saved, and it will result in 40 new shares. Resultantly, the number we get is 1.225. This is clearly lower than our 1.29 per share basic earning per share. So these securities are dilutive, so they would be considered as dilutive. What about D? Let's check D as well. 10% convertible bonds, 10% times 1000 times 1 minus tax rate, and these convertible bonds will convert to 20 new shares. So if you simplify this, what you get in the numerator you will get $70, and in the denominator you have got 20 shares. So if you simplify, 3.5, which is much higher than our basic earning per share. So they are anti-dilutive. So anti-dilutive, no information given regarding convertibility. This is the one that is dilutive, so C is the right answer. Jones Corporation capital structure was as follows. During year 2, Jones paid dividends of $3 per share on its preferred stock. The preferred shares are convertible into 20,000 shares of common stock. The 8% bonds are convertible into 30,000 shares of common stock. Net income is for year 2 is $850,000. Assume that income tax rate is 30%. What is the diluted earning per share? So for diluted earning per share, we need the adjusted income, and in the denominator we will have the adjusted shares outstanding. So we start off with $850,000, right? We no longer would be required to pay interest, so we need to add back interest on after tax basis. What is the figure for interest? $1 million, right, multiplied by 8% times 1 minus tax rate, which happens to be 30%. So if you add back the interest saved when these bonds are converted, you get 56,000, right? So this is the numerator. If you add these two, 906,000, right? So we haven't deducted the preferred stock dividend, assuming they have been converted to common stock. So we already had 110 common shares outstanding. These 20,000 shares are converted from preferred stock to ordinary, and then we have these 30,000 that are convertible from bonds. So we have a total of 110 plus 120, 130 plus 30, 160. So 906 upon 160 gives you 5.662, which is D. The following information is relevant to the computation of Chen Company's earning per share to be disclosed on Chen's income statement for the year ending December 31st. Net income for 2002, $600,000. Okay, what else do we have? $5 million face value 10 years convertible bonds outstanding on January 1st. The bonds were issued 4 years ago at a discount which is being amortized in the amount of $20,000 per year. The stated rate of interest on the bond is 9%, and the bonds were issued to yield 10%. Each 1,000 bond is convertible into 20 shares of Chan's common stock. Chan's corporation tax rate is 25%. Chan has no preferred stock outstanding and no other convertible securities. What amount should be used as a numerator in the fraction used to compute Chan's diluted earning per share, assuming that the bonds are dilutive securities? If this is so, we need to adjust the numerator for the interest saved. So this is the net income, which is we add back the interest saved. What is the amount of interest we pay? $5 million multiplied by the stated rate. This is the interest payment every year. Now the key point here, which most of you might ignore, they have a discount on bond issue which they are amortizing $20,000 per year. So they are clearly companies using straight line amortization rather than the effective interest amortization. So under this straight line amortization, interest expense is interest paid plus the discount amortized. So the amount you're going to add back to the net income is 450 plus 20, 470. Since it needs to be reported on after-tax basis, so you're going to multiply this amount with 1 minus tax rate, and if you simplify this part, it will be 352. So 352,500 plus 600,000 gives you a total of 952,500, and that is C.